You start very big, pages and pages of themes, and you start debating and you realize it's usually like 4 or 5 key themes. What are the key themes that carry out throughout all these scenarios? The path of inflation, it should moderate. Does it ultimately moderate? How quickly does it moderate? Economic growth, what happens? That's highly influenced by things like fiscal stimulus and the virus, and how that plays out, as well as China, what they end up doing. And then how do policymakers react to all this, and what does that do to asset prices? Those are the things.
2022 investment outlook. Chose a movie this year. Choice was The Wizard of Oz, because we've realized that we're not in Kansas anymore. So we're just trying to assess the world and probabilities based on the data. So just read the data and assess probabilities. And that's really what we do every day. And then we try to, once a year, translate it into this narrative / entertaining metaphor where we can find a movie that it fits. But let's go through our 3 outlook scenarios like we do every year.
Yeah, and hit the highlights. So we will start with the bear case. There's no place like home.
Let's take a look at the lead into the bear case.
The bear case. There's no place like home. Investors learn the hard way that stimulus-induced inflation is even more wicked than her dead sister, the COVID-19 recession. Policymakers once again try to convince consumers there's no place like home due to increasingly transmissible and evasive variants of concern, while opportunistically ratcheting up stimulus before midterms. Runaway long-term interest rates eventually yield to rapid rate hikes and slowing economic growth, conjuring up stagflation, capital flight from China, and a bear market. Oh my. The hazardous and technically unexplainable reverse wealth effect sends equity indexes back to pre-Technicolor Kansas. Our bear case probability is 20%.
Nobody really wants to go back to Kansas, right?
Right. Nothing against Kansas.
Kansas in the 30s.
In this analogy, Kansas would be going back to where markets were during the depths of COVID or before that.
Yeah.
I mean, nobody wants to go back to 3,300 on the S&P 500, right? Nobody wants to go back to where we were pre all this stimulus.
Right.
We want to keep asset values this high.
Yeah.
In the bear case, whether it's because of more lockdowns and more stimulus means that, or because supply chains just don't heal fast enough, inflation runs far too hot.
Right.
It does not moderate. If inflation does not moderate, the Fed might feel like, I need to solve this problem the only way I know how, which is by hiking interest rates. If the Fed hikes more than is expected, that is not going to be good for asset prices. A lot of areas of the equity market, the valuations only make sense because the federal funds rate is near 0 and they're not aggressively hiking. There could be fears if the Fed has to hike 4 or 5 times to try to get inflation under control. There could be fears of stagflation, potentially a recession in the back half of 2023. It would also put China in a very difficult position where they would see capital flight and they need all the money they can to manage their own domestic issues. Not a great situation for equities. Wouldn't be surprised if at some point during the year you see a peak to trough drawdown of 20%.
So inflation, aka the Wicked Witch of the West, can't be defeated in this scenario, and we have accelerating inflation, and it's definitely something the Fed has to aggressively, in the face of decelerating growth, has to aggressively go after. Okay. Right. Walk through the price targets in this scenario.
So we're not predicting, even in this bear case, a recession. That seems very difficult given where savings are. This is a bear case because of the Fed's reaction function, and also because of fears of stagflation next year.
Right.
The market will price that in. If the Fed has to hike 5 times this year because they're trying to get inflation under control, because supply chains don't heal, everybody at the end of this year is going to start pricing in a recession in 2023. And if you have a recession alongside runaway inflation, that's stagflation, and that's awful.
Bad.
Valuations don't make sense. So you see the 10-year yield at the end of the year, we have 2%, which isn't runaway, but a 2% 10-year after 5 rate hikes That's ugly.
Yeah, from where we are today, it's ugly.
Yeah, that's ugly. That's a very flat yield curve that's pricing in something like a recession.
Yep.
And if the Fed has to hike that aggressively, that means bad things for certain areas of the equity market. Valuations don't make sense. You see one of our tagline, because if cash flows aren't there, I never really lost them. Basically, you have all these stocks that have very high present values, current stock prices, because they're promising investors 5, 10, 20 years out in the future, I'm going to make money. I'm going to generate cash flows, and I'm going to return them to shareholders. And the only reason why it has a value today is because those cash flows 20 years out in the future, which you never really are going to get, you can discount them at almost a 0% interest rate.
Mm-hmm.
And so the present value is high. Those cash flow projections way out in the future in this scenario, not going to work out.
Yeah.
A lot of those really exuberant areas of the market, they're not going to make it through an aggressive Fed hiking cycle. If history,
plays out.
Yeah.
Yep. And what happens to asset classes like commodities or the dollar in those instances?
Yeah, the dollar, you'd probably see a flight to safety with the dollar. And also because the Fed would be hiking, short-term interest rates would be high. Mm-hmm. And so you're going to have this carry trade where, not only do I like the dollar because I'm thinking there might be a recession next year, but also I'm getting paid a good interest rate, reasonable mm-hmm. interest rate to hold it. So the dollar should strengthen, but you could also probably see an environment where commodities are probably higher than you would think given recession fears because of their value as an inflation hedge. And because a lot of folks, supply chains are still going to be a mess here, and people are going to try even harder to try to solve those problems. And a lot of these supply chain solutions involve commodity inputs. If you're going to onshore your supply chain, you're going to have to build factories, you're going to need stuff.
A lot of commodities. Yeah.
So commodities could perform better than people might think.
Right. And in terms of equities, we have a price target. We know price targets are just sort of areas or broad targets, but like 4,000 still, that's not a big decline from where we are today.
Yeah, it's 12% down from where we are today. Part of the bear case is you're probably going to get some easy money in the early parts of the year potentially. Wouldn't be surprised if this bear case plays out from sort of high to low in the year, mm-hmm. if you do get 20% downturn.
So this scenario pegs GDP growth at 2%. For the full year, which is sort of below a lot of analyst forecasts. Mm-hmm. So how do we get to that number?
Yeah. Consensus is right around 4%, mm-hmm. and that's factoring in not a great virus outlook. Things like more restrictions, Omicron becoming dominant and causing, more lockdowns, work from home, return to office being delayed. So how you get GDP that's half of that, in our view, is the reverse wealth effect. So we have here quoted, the hazardous and technically unexplainable reverse wealth effect. And basically, the idea behind that is all throughout COVID, economic growth was better than everybody expected because everybody had money. And even if they weren't buying stuff, they were buying assets and they felt wealthy, so then they bought stuff. Yeah. Right? If everybody right now, if their stock, bond, crypto portfolio, their financial assets take a 20% hit, that is going to curb spending. That is going to stop people from thinking about buying that second or third home, mm-hmm. Moving somewhere, right. Like big purchases. They're going to say, oh my gosh, inflation is running away. Everything I wanted to buy is more expensive. And now my portfolio is down 20%. Yeah. I'm done. I'm going to take a breather. So that's the primary reason why GDP growth would get hit. Mm-hmm. Not necessarily because the virus goes out.
Yeah. Rates are higher and I can't get money. So
we know how to stay at home and buy stuff. Yeah. That's not a problem as long as we have money. In this scenario, you feel less wealthy and you buy less.
Yeah. Cool. The bull case is a fantastic case because you get to stay in Emerald City, and that's a great place to be. So let's take a look at the lead into the bull case.
The bull case. Somewhere over the rainbow, the mere threat of the great and powerful Jay Powell aggressively hiking short-term interest rates, combined with the relaxation of the final wave of COVID-19 lockdowns, are enough to unravel every supply chain riddle, steepen yield curves, and knock inflation off its broomstick. With inflation expectations melting like lemon drops, Markets way above their prior tops, and the economy in a sweet spot, I'm told, where it's never too hot and it's never too cold. The Fed gives a couple of la-di-das, and investors laugh the year away in the merry old land of Oz. Our bull case probability is 20%.
The bull case is beautiful. The biggest thing is inflation moderates quite rapidly.
Mm-hmm.
If that happens, it takes so much pressure off the Fed. So much pressure off the Fed. So if we get to a situation where the economy we're sort of learning to live with the virus, or the reaction function by policymakers is not let's go back into lockdown, but more, hey, thankfully this is more mild, we're going to learn to live with this. Or consumers say, I'm done putting off experiences. I've been vaccinated. What more can I do at this point? I'm going to go out and spend on services. And people just stop just buying stuff, just sitting home and buying stuff. What could happen is supply chains actually heal pretty rapidly. You can have this great sort of Goldilocks environment where the economy is delivering growth above expectations, which it has done. Mm-hmm. So continuing to do what it's done. Consumers spending more on experiences, either because of fatigue or more lax policy from policymakers. Inflation moderates, which allows the Fed to very easily pivot, and you could have a pretty good upside scenario.
Yeah,
it's a great environment for corporations to make money. It's a great environment to broaden out the economic recovery, and the Fed could underdeliver.
So we're looking at GDP growth of 5% in this scenario. Estimates are around 4%, so this is definitely a surprise to the upside.
Mm-hmm.
So take us through some of the factors here and how this would work.
Yeah, if you get inflation to moderate and you get people to feel comfortable one way or another spending more on services and experiences, they have the money to spend. They just want to spend it. Having a 5% GDP handle versus 4% consensus, very easy. Also, this is not factoring in any type of stimulus. If you don't get anything sort of huge in terms of stimulus, that would spur more inflation fears. But just around the edges, we continue the advanced child care tax credit. You forgive some student loans, things like that. You could definitely deliver 5% GDP growth. Also, if you factor in what's going on in the rest of the world, right? I mean, if all these other economies, if Omicron rips through them, and they come out on the other side of it, ready to do business, there could definitely be an impact boosting our economic growth as well.
And there are definite signs of that.
Yeah. For sure. And inflation falling to 2.5% by the end of the year, that's pretty reasonable. The consensus is around 3.5%.
Yeah.
So, and everybody, all the king's horses and all the king's men are working to solve supply chain problems, right? And corporations have a lot of money and a lot of smart people trying to work through these problems.
Yeah.
And odds are they will.
Yep.
Right? So 2.5% on the inflation handle isn't out of control. Fed probably would only have to hike 1 to 2 times in that type of a scenario.
Mm-hmm.
Why be more hawkish?
So why wouldn't they hike more in good times?
Yeah.
Just to get ahead of it.
Yeah. So in our view, if they weren't currently still buying right now as we sit here today, still buying $100+ billion in assets, they probably would be hiking. That's why they think they're so offsides. So they're doing the next best thing. They're doing their Wizard of Oz impression, right? All the smoke and the fire, and I am going to be the hawkish and great and terrible Jerome Powell, trust me, right? Because that's all they can do right now is talk.
Yeah.
The good news is it's not as good as just hiking rates, but it does have some impact in reducing inflation expectations.
Mm-hmm.
We're already seeing that in the market. So there's a scenario here where the great and powerful Fed just threatening these rate hikes is enough to get inflation expectations under control.
Right. Yeah.
Bark a lot, you don't have to bite.
Yep.
Right. So
scare Dorothy off to go to the witch's castle to get the broom, right?
Exactly. She comes
the
back
power
with the
they
broom.
have.
It was real easy.
As we look at the different price targets here, take us through. You've got you talked a little bit about inflation already. Talk about where the 10-year yield lands here.
Yeah. So 2.5% on the 10-year yield. That number needs context. You would say, well, that's actually higher than your bear case. Bear case, you said 2%.
Right.
and you're worried about stagflation in the bear case, what matters is the steepness of the yield curve, why long-term rates are rising. That is the most important. In our view, inflation expectations coming down and the Fed hiking less than expected, if that plays out, it will be in an environment of moderating actual inflation right now and strong economic growth, and it should cause a bull steepener. It will be very bullish for equities, particularly more cyclical, interest rate sensitive equities, things like financials. Those areas of the market should do very well. And 2.5% on the 10-year. The 10-year is a coiled spring. It's looking for any excuse to shoot up to 2.5%.
Right.
In the scenario, we get there gradually, which is important. And we get there because the Fed is under delivering and because inflation is not running away.
Right.
So it's not to be feared with 2.5%.
And given all the, even, and I think a point of evidence of this is with Omicron sort of ripping through the world right now, the 10-year really hasn't gone to where we thought it might go if this happened.
Yes.
It's still kind of sitting right around the 140 mark. And
Right.
we would expect it, if it was a real thing, it would probably be down below 1.
Yeah, if there weren't pent-up pressures for it to move higher, you're exactly right.
Yeah.
We would have expected Omicron. Omicron is basically as advertised, so the 10-year should be down around 1, and it's not.
Yeah, so the price target for the S&P, 5,200.
5,200, quite reasonable.
Yeah,
Um,
that's a good year, right?
Yeah, another great year. It's not far off. You just think as long as there aren't significant changes on the tax policy side, earnings should be somewhere between 8 to 15%. I know that's a big range. You could drive a truck through it, but companies have been beating estimates so easily that you have to have a big range. But yeah, I mean, earnings, that should almost all be earnings and dividends. So it's not anything crazy. There are a lot of strategists on the street, and that's their base case. So that seems pretty reasonable. The dollar should weaken. This environment is great for the world, inflation moderating. Money should flow into emerging markets. Emerging markets, a lot of them, either they've already gone through their hiking cycle or they should have. But ones that have already gone through their hiking cycle, if inflation moderates and their short-term interest rates are very high relative to short-term interest rates here, money should flow there. So money should flow into other currencies. So it's pretty good.
And so just overall, and then maybe we could comment on commodities, since they're such a big focus over the last 18 months.
Yeah, commodities in this situation probably have sort of a nothing year. There'll be areas of the commodity market that will do well, but overall, commodities in a moderating inflation type environment, you have this cyclical downtrend, inflation moderating versus this structural, in our view, long-term boom cycle. And so they just take a break for a year, which is fine. I mean, they were up like 40%, 2021 thereabouts. So just take a break for a year.
And so the base or the bull case is 20% probability. What is our view on sort of how this could play out during the year? Is this a front half of the year, mid-year, back half of the year?
This also will probably play out most significantly in the back half of the year, because if you think about the known knowns, known unknowns framework, the next 3 to 4 months, the known knowns are pretty baked in, and people have pretty good view into them. Once we get past April, that's where you're really going to see. Now the Fed can pivot more dovishly. Inflation is moderating much quicker than we expected. The stimulus that China is enacting is starting to take hold. Back half of the year would be really nice.
Where this comes in.
Yeah.
Awesome. So just relate some of this to the movie for me.
Yeah. Back to the movie. So you start out with the song Somewhere Over the Rainbow. Dorothy sort of fantasizing about a world that has no problems and is beautiful. Well, that world exists. If you recall in the movie, it's the Emerald City.
Yeah.
You get through the poppies, you're on the yellow brick road, you arrive at the Emerald City, and it's beautiful, and you get shined up. And this is basically the situation where they get to Emerald City. The witch has already fallen off of her broomstick, so she's not there to say, surrender, Dorothy. And the wizard doesn't have to send Dorothy and the Tin Man and the Scarecrow and the Lion on the mission to defeat her, which ultimately leads in him losing credibility. He's never even put in that situation. They just say, hey, this place is great.
Never gonna
Why
leave.
would I want to go back to pre-Technicolor Kansas? Right? It was so black and white back then. This is awesome. I'm going to stay in the merry old land of Oz and laugh the year away.
It's a good place to live.
Yeah.
Okay, so the main theme of the movie is following the yellow brick road. So that brings us to our base case.
The base case. Follow the yellow brick road. Investors skip down the road of economic normalization, hopeful that Tina will protect them from wicked inflation. Governments will provide a light dusting of stimulus, and the Fed will do wonderful things to support stock prices. In their first Fed meeting after the taper, the great and powerful Jay Powell says the Fed has every intention of granting investors' requests for higher stock prices, but only after inflation has melted. Investors fear the red sands of time are running out before rate hikes steal Tina and destroy portfolios. Base effects, COVID-19 indemnification, and CapEx work together to throw water on inflation just before the next Fed meeting, where investors peek behind the curtain to find out Powell was all talk. Our base case probability is 60%.
We have a very high probability on this case, and there's a lot of elements that go into this case.
The base case is the path of normalization in the economy. So in terms of inflation and economic growth, it will basically go as planned, which means inflation should peak somewhere in Q1, and inflation and economic growth should both normalize throughout the rest of the year. And that's sort of the yellow brick road.
Mm-hmm.
Now, on this yellow brick road, what you're faced with is how policymakers are reacting to this moderation. There are going to be some scary times. This is really the first Fed meeting after the taper we think is going to be tough. So you're talking about the May Fed meeting in particular, early May. Well, put yourself in that situation. So here we are, we've gone through the taper. I've priced in 3 rate hikes. I've said I'm going to do it. I have to do at least one.
Yeah.
Right? Or else I totally lose credibility.
Right.
So I'm going to hike rates in May. But at that point, inflation should be coming down and economic growth should be slowing naturally. So these things directionally are going in the wrong way. And it's probably going to set investors up for a classic, the Fed is hiking too much, far too late type of a scenario.
Hiking into a slowdown.
Exactly, hiking right into a slowdown like they do every single time, right? And so that's going to be scary, especially if at that first Fed meeting, not only does the Fed hike, but Jay Powell makes some mistakes. If he comes out hawkishly with all the smoke and the fire and he's scary and off-putting, that could definitely send markets into a tailspin.
Yeah.
That could definitely create a lot of volatility, which sets us up for whether it's the next Fed meeting or one after that. But basically, in the base case, it includes a pivot by the Fed because the market will give them feedback in terms of, hey, this is bad. You're going to do too much. I'm giving you real-time feedback. Inflation and economic growth moderating, and that gives them the perfect opportunity to pivot. And maybe it's still in that next meeting they hike, but they deliver it dovishly. So they deliver it in a way that says, we're going to take a pause after this. Our economic and federal funds rates projections over the long term have come down. So the path of future hikes is far more mundane. And that will be exactly what the market needs.
So why do we think the great and powerful Oz will be able to do that? What evidence do we have?
So actions always speak louder than words. If Powell gets feedback from the markets and inflation is moderating, there's nothing forcing his hand, he's done it before. So that's great.
Yeah.
Hopefully he can do it again. Also, he's going to be under a lot of pressure politically before the midterms to not do anything. That could disrupt markets further.
Yeah. He's been in this movie before, right? In 2018, sort of faced the same situation, and he got stung quite a bit by that.
Exactly.
And so it's we're assigning a higher probability because we think he really has learned that he needs to play to the market a little bit more.
Right. So So yeah, that's a big part of it. A big part of it. The other part of it is this idea of COVID-19 indemnification.
Yeah.
END.
Let's talk about that.
So that idea is, the narrative about this becoming a global endemic. We think Omicron, although it's very negative in the near term, is another straw in that hat, if you will, feather in that cap, is what I should have said. So, and as we get to the end of next year, even spring of 2022, people have been dealing with this for a long time.
Yeah.
And they followed the science, they vaccinated, they boosted. They're not going to put off experiences for much longer.
Right.
Plus, they think, you know what, I deserve it. I've been through a lot, right?
Yeah.
Especially all these folks that have retired early. Well, you don't retire to stay locked up in your house.
Right.
Right? And you have money. And in this scenario, markets still support people spending and sort of living their best life.
Yeah.
And so that's going to keep economic growth humming along. And that transition from goods to services is going to be a big reason why we think inflation moderates. And as inflation moderates, the Fed can be less hawkish.
Yeah. And we're already seeing seeds of that sprout, right? Travel's up, hotel bookings are up.
Yeah.
So it's already happening. Right. So what does that mean in terms of sort of our GDP growth? We're pretty much in consensus with everyone else.
Yeah, the base case at 4% GDP growth, that seems about right. What's more important is what is growth at relative to inflation? And yes, it's going to normalize. How quickly does it normalize? Those things are more important than the number.
Right.
This is a gradual moderation of growth, which is not going to scare anybody. That seems to make sense. We have these shock absorbers in terms of economic growth, which are, one, companies need to rebuild inventory.
Yeah.
Even if demand fell off a cliff, companies are going to rebuild inventory, 12, 18 months of inventory in some cases. They're just still going to be buying stuff, and that flows right to GDP. So that's a nice shock absorber. And consumers have money. So even if they can't spend it today, they can spend it tomorrow. So you can feel reasonably confident that growth should moderate, but not too quickly. And that as that happens, inflation should moderate. Once again, we have 3.5 on inflation. The number at the end of the year is not as important as the path and how the Fed and other central banks react to it.
What about the lag effect of housing prices on rents?
That's definitely going to be why we think we're going to cool to a higher low. So we're talking about the path towards normalization. Are we going to get to a 2% inflation print? No. It's already baked in the cake that because housing prices have gone up so much, so quickly, that's going to flow through to rents. And rents are a huge chunk of the CPI basket. So cooling to 3.5, yes. Cooling to 1.5, 1, almost impossible, just how the numbers work out because of rents.
Yeah. And what do the Fed funds rates look like at the sort of throughout the year? How do they sort of transition from start to end?
The Fed has basically talked themselves to the point where two things we have reasonable confidence in. They're going to wrap up the taper in March, and they're going to hike at the May meeting. From there on out, tough to say. Probably what will happen, in our view, is you get the hike in the May meeting, maybe one more in June or July. Maybe,
yeah.
Because they probably said more than they should have during the May meeting, and now not only do I have to hike in May for credibility's sake, but I actually have to hike in June for credibility's sake.
Yeah.
And then after that, I can stop.
If they can get away with it, they probably will.
Yeah. So it's probably going to be more front-loaded in terms of rate hikes.
And the 10-year yield, right around 2-ish?
2%, yeah, very reasonable. Up about 50 basis points from where we stand here today. That, within the context of the Fed under hiking relative to expectations, is very benign. TINA lives. It will not disrupt TINA.
Still there.
We think that's just a reflective of the indemnification of COVID and the Fed hiking less than expected and economic growth continuing to come in strong.
And the S&P up 7%. That's not a bad year. That's historically a good year.
Right. Relatively speaking, relative to the last 3 years, obviously it's not great, but that's a good year. That would, in our view, that would be valuation compression. So valuations would come down a little bit. Earnings would probably come in above 7%. So stocks, if you look at things like earnings yields relative to long-term earnings, they might actually get a little more attractive next year. So,
and commodities generally, what kind of year are they going to have in this scenario?
Yeah, not anything to get too excited about. There will be pockets if you pick the certain areas of the commodity market that do really well. But once again, in a year where inflation is going to moderate, you're not going to see gains like we did last
18 months. So as long as we stay on the path, even though it's winding, we will achieve our goals and defeat the witch and perhaps live in Oz forever.
Exactly.
So we really do enjoy this process. It's a lot of fun for us to put together the outlook, and super appreciative to the research team for all the hard work they put into this, and especially to Mike for all the effort he puts into tying the investment research to the movie itself. So thank you for that. And we hope you enjoy this outlook. And certainly if you have questions, we're always happy to talk through it.